I don't know whether these coalition talks breaking down impact growth in Germany, whether they impact actually the periphery because you still don't have a government, or whether it actually impacts Brexit more.
Well, first of all, great to be here. Thank you for inviting me back on. We're going to go through a period of uncertainty. It's clear, as Matt said, there's three potential scenarios in Germany. We have a minority government, we have a grand coalition, or we go back to the polls. And the problem being, if we go back to the polls, actually there's very little evidence we're going to get a different result or a materially different result from a new election than we got last month. So we're entering a period where there's going to be some uncertainty. That may be a drag for German markets. But investors have learned through the events of the last year or so that actually politics only has a very short-term, temporary impact on markets unless it has a macro implication. So investors have bought the dips. You see them buy the dips over Brexit, buy the dips over very quickly over the US election result, over Italian constitutional reform, and I think you'll see that again this time. So the key question is, will political uncertainty lead to a slowdown in the economy? Well, the evidence so far is absolutely not. In fact, the European economy has been extraordinarily robust this year. We've seen no evidence of that faltering since the German election. And actually, when you look at where is growth most robust in Europe, the answer is Italy and Germany. So far, what you're seeing is political uncertainty is not causing industry to slow down its intentions around hiring or investment.
Yeah, Richard, I look at where we are as we greet Monday into the holiday week here in America, and maybe it's time to reform on a view for 2018. Are you and your BlackRock team, because of all this politics, going into 2018 with a confident call on allocation, or does the politics lead to an uncertainty?
I think there's increasing confidence about the macro environment, Tom. And in fact, I think we've rarely been in an environment where the global macro growth rate has been so stable and so broad-based. So we're seeing robust growth in the US, here in Europe, and at Asia simultaneously for the first time. The breadth of that growth is increasing. And in fact, there's even prospects now we could get fiscal stimulus in the US, actually potentially in Europe and in Asia, to further support that growth. So confidence around growth, I think, has rarely been higher in the sustainability of that growth. So that creates, I think, a tremendous backdrop for investing in risk assets. We remain positive on risk assets going forward. But it's clear there are risks, and it's clear also that markets have priced in a lot of the good news. So equities have made significant progress this year, and that's why we think the right thing to do is to focus on where you're still being paid to take risk, and that still points to areas like Europe, like emerging markets going forward, like Japan, actually, where valuations still look very reasonable to us.